Hi, everyone. This is Gary Wilson, and welcome to this week's live Path to Prosperity webinar. Excuse me. We're all muted by default except for me, and that's because we can't always be on here vocal at the same time. So you can use the chat box, so please use the chat box for raising your questions, okay? From time to time, I'll unmute you, so I might unmute Louis tonight since we're going to base tonight's webinar on an email he sent me asking about the world of finance and interest rates and banking and so forth. So if I need clarification, I might unmute Louis. But in any case, also always look the next day for the recording of the webinar. There'll be email that comes out from Beverly, and make sure you always, if you don't ever see email you're expecting, always check your spam or junk folders. I mean, I'm guilty of that too. Even the people on My Investment Services, the team, one person in particular named Judy, half her emails go to spam for some reason. I have no idea why, and I'm on their email system. But in any case, check that first, and because it's going to happen there, the recording, of course, and these scheduling updates. For example, we have a scheduling update for you. The week of the 25th, the webinar was originally scheduled for Tuesday night, the 26th. I had to ask Beverly to move that back one day to Monday, the 25th, because I looked at my travel plans, and they had changed since the time we made all these plans. And well, I had the default to having to move it back to Monday, so I hope that's okay for everybody. So look for that next Monday night. Sorry, not next Monday, the Monday after. And that will be, of course, 6 o'clock Central. You know the drill. So in any case, also there are definitely going to be some system updates. You've probably noticed some updates to the My Investment Services website in the last couple of months. They're almost completed the installation of a new learning management system called Access Ally. It's going to replace digital chalk. If you're already on digital chalk, you're going to be grandfathered in. You don't have to worry about conversions and things like that. Any new students going forward will be on Access Ally. So in any case, just we're going to keep you abreast of the changes that the vendor is making to their platform. So in any case, always look for those. Look for the email from Beverly, and I appreciate you guys doing that because it helps her save a lot of time and energy. So without further ado, let me go to Louis' email. This is from Louis Reset. Louis is from St. Catharines, Canada. So Louis, thanks for doing this. And first, by the way, let me do the share. So hang on one second. Okay, let's do share. And there we go right there. Share screen. So you should all see this email from Louis. If Louis, you wouldn't mind to just send me a quick chat, just letting me know that you can see the screen. That way I'll know everybody's able to see the screen here. And that would be great. And while we're waiting on that, let me just kind of give you the gist of the subject. So Louis is asking, actually, let me just double check it real quick on the chat box. I got 2 chats. I just want to make sure that everybody's okay. Let's see. Yep, can see it. Thanks, Louis and Pierre. Thanks, guys, for doing that. Okay, let's see. Oh, Beth's saying, Gary, I need to talk to you for 3 minutes after the call about a potential investor property. Yeah. Hey, Beth, yeah, let me, right after the webinar, I already have 2 calls. Let's see. If I call you at 8, would that be okay, Beth? So if you let me know that, I'll call you at 8 and text me. So I know I have your number because we just had a strategy call, but just to be safe, text me. That would be awesome. Okay, thanks, Beth, for doing it. Oh, let me go ahead and write this down. I won't call it out, Beth, I promise. Actually, you probably would like me to call it out because these guys can send you a referral. So this, hey, let me write this down. Okay, excellent. And that'll be around 8. Okay, so let's do this. I want to just read this just quickly. So Louis is asking, okay, I have a request, kind of a different topic. And it's definitely a very, very pertinent topic to real estate investing, which is interest rates, finance, and sort of. So Louis knows I was in the banking world for about 18 years. I was on the deposit side of the house initially, and I ended up doing mergers and acquisitions for about, man, that was a lot of years, probably 15 years. No, let's see. Yeah, actually about 15 years of mergers and acquisitions, and it basically just fried me, okay? So I'm way happier now, much more at peace. But I did learn an awful lot. So let's just do this. It's going to talk about real estate investors in a changing market. For example, the credit market is bigger than the stock market. And given negative yields on bonds, what can that mean or should, let's see, bonds, what that can mean should interest rates, should interest rates shoot up, and how can we investors protect ourselves? So let's just start with, that's an excellent question. First thing is this, just so you guys know, for those of you who are in the United States, typical residential mortgages are fixed rate mortgages, and typical investor mortgages have an adjustable rate. So if you get a commercial loan to buy an investment property, you notice it's going to have probably a 5-year repricing. It'll be fixed for 5 years, and in 5 years it'll reprice, and maybe it has like a 15 or 20-year payoff. In other words, it may reprice 3 or 4 times by the time the loan is paid off. There's other things you can do, like balloon mortgages, where you can have a loan amortized for 30 years with a payoff at 15 years, and it may reprice every 5 years also. So all kinds of combinations. Well, the reason I bring this up is in Canada, interest rates are a little bit lower in Canada than they are here in the States. But in Canada, even residential mortgages are variable in nature. So in other words, the bank protects themselves from having, say, a lot of low interest rate loans out there, and then interest rates go up over time. And then they have a lot of loans that are paying much lower than the prevailing market rates. So unlike the United States and Canada, commercial and residential loans both can be variable rate, and quite frankly, usually are. They have like a 5-year term that are repriced. So if you think about it, if you were a lender, and right now interest rates are 2 and 3 and 4%, and we have every reason to believe, based on history, their rates are going to go up, and I believe they will go up. I just can't tell you when. What would you do? Well, naturally, you would protect yourself. You want to give people a good deal today because you have to lend money to make money. That's how we make money in banking. But at the same time, you want to protect yourself, hedge yourself against future interest rate hikes. So as the Fed raises rates, that trickles down, then the banks have to raise rates. So the banking system is kind of it's sometimes not what we think. In fact, if you didn't know this, and I encourage you to study this, there's some great videos out there on the Fed. Federal Reserve is not a government agency. It's basically it's actually a bank. It's a private entity, but it is very heavily regulated. And the governors, you have the head, the Fed chairman, and then you have local, like there's 12 different districts. They have individual chiefs. They're appointed. Okay, so it's kind of a unique scenario. It's not a government agency, yet the government has some control over it. So the president can appoint a Fed chairman, for example. In any case, so as they raise and lower rates, what happens is the bigger banks, like Bank of America, Chase Bank, Chase Citibank, they're the big 800-pound gorillas. They will also change their rates, and then there's a trickle-down process where, like a small local bank. I'm here in Louisiana right now, so what was the bank I saw earlier today? A small community bank up in Denton. It was in Denton Springs. I think it was the Bank of Zachary Bank, something like that. Small community bank. Well, they'll borrow money from a larger bank, like, say, Bank of America, for example, okay? So banks actually borrow and lend money to and from each other, and it kind of goes up and down the ladder, so to speak. And believe it or not, there's, of course, the World Bank and things like that that are really they're the ones kind of controlling everything. They're like Geppetto with the strings controlling the puppet, right? So in any case, a lot more. I should not go down that path because we'll be here all night if I go down that path. But just know this: a lot of times, what you're seeing in the world is not really what's really happening behind the scenes. Okay, now everything's designed for you and I as consumers to use the banking system, not just for deposits but for loans. And as you might imagine, banks make more money on loans than they do on deposits, way more. And so it's in their best interest to have all of us be in debt, to have all of us borrow money, to buy houses, to buy cars, go on vacations, to buy furniture and stuff like that. Pay for Christmas, okay? So that's all by design, all right? The United States, at least the United States, became a debtor nation as a result of after World War II. It started way before that, but started back in like 1913 was when the Fed was first created. But in any case, fast forward, If you're into wonder why is it so hard for me to get ahead? I'm constantly in debt. It's by design. Okay. I used to be in banking. I'm telling you, credit cards, you would wonder how banks actually make money on credit cards and people default on them all the time. They make a ton of money on credit cards. Most people don't pay them off. They use the money, they use the credit card to buy something, and then they just pay the next minimum payment. And the banks also make money on the merchants, the provide people who have credit cards or take credit cards for payments for goods and services. They're paying fees also. Okay. So believe me, the banks have no problem letting you use credit cards. If you think about it, probably 30 to 40 years ago, banks were sending credit cards to college students and university students while they were in university. They didn't even have a job yet, and they were getting credit cards, okay? They were training them, conditioning them to be in debt. In any case, let's fast forward here. When we in a low interest rate market and we believe interest rates will rise, we definitely want to lock into rates as best we can, as much as we can. In most cases, if you're a real estate investor or you're working with investors, which most of you are doing, and they're buying investment properties, most likely they're going to be getting conventional or commercial loans. See, investors don't like FHA loans. Now, having said that, obviously, if you can get an FHA loan, like you can usually use FHA loans in some cases up to 4 properties, and in some cases up to 10 properties, okay? You may want to do that now because you can lock into the rate, lock into the low rate now, and it's fixed for 30 years, right? But what happens is after a certain period of time, you no longer can get FHA loans if you keep buying properties, but you can get conventional loans. Conventional loans are typically coming from community banks or banks that do what's called portfolio lending. They don't sell their mortgages. See, Bank of America, Citibank, TD Bank, they all sell their mortgages. I'm sorry, TD in the United States sell mortgages. In Canada, I might as well just tell you this now. In Canada, we don't sell mortgages up there. We don't sell them at all. And quite frankly, that's why in Canada, when the U.S. was going through that major recession, Canada never skipped a beat. It just kept trucking right along. Never had a recession. Home prices went up from an average of $250,000 to $500,000 like almost overnight. Now they're up to like $1 million around Toronto. It's crazy. But in any case, when you work with a small local bank, you're going to get typically what's called a conventional mortgage. It's not an FHA underwritten loan. That bank is holding that mortgage in-house. Well, there's some pros and cons here. One of the pros is they don't have to follow all those crazy FHA guidelines. Number one. Number two is they can be more creative. They can be more flexible in their lending practices. So if you might guess here, I'm a huge fan of working with community banks who are portfolio lenders, okay? Credit unions are another good source of money. They're credit unions, and we have credit unions in Canada just like we have in the States, have a different chartering mechanism. So you might want to write this down. Credit unions by design, by definition, are nonprofit, okay? So they have different tax implications. They have a different chartering mechanism. And a lot of times they're owned by the members. So if you're a member of a credit union, you're actually a member, okay? And you can own a share. You own shares, whatever the case is. But back to this. Let's just go back to the community banks. When they give you a loan that's a portfolio loan that's held in-house, that's called a conventional mortgage, okay? And here's why I like them. I can often negotiate with them. So Louis, I'm going to start answering your question here more directly. When I'm working with a portfolio lender, I know that I can negotiate with them. I can say, look, I want longer than 5 years on my current rate. I want to lock it in for 10 years. What do I have to put down, or what do I have to do? What do you have to do to raise your interest rate to reduce your risk? This is you speaking to the lender. So this is kind of a script you can use. So you go to a community bank, you want to buy a property. Instead of getting a 3 or 3.5% mortgage, it's going to change in 5 years. You can say, look, what rate do you have to give me a fixed term for, say, 10 years or even 15 years? And they'll tell you, they'll do a calculation. They'll say, well, it's going to be 5% or it's going to be 5.5%. I know it's more than what the current rates are now, but it's a way for the bank to protect themselves from future rate increases, okay? Personally, right now, I've been investing for 34 years. Guys, I would take 6% in a heartbeat, okay? I mean, heck, in the late 90s, everybody thought times were great because they were paying 8 and 9%. But that's because in the 80s, they were paying 15 and 18%, even 21% in some cases. So historically speaking, to me, 6% is awesome. So one of the things you can do to protect yourself from future rate increases if you're buying properties is to negotiate your rate. It may be a higher rate, but you can have a longer term. So that's one thing you can do. Okay, so let's let that settle in for a second. Another thing you can do to sweeten the spot for the lender, reduce the risk, is to put more money down. Don't just put down 20%, put down 35%. Okay. I know some of you are thinking, my gosh, I don't have that kind of money. My clients might not, but some of them do. And that's just one of the strategies, which is put more money down to reduce the risk to the bank. You can also ask them to shorten the overall term. So in other words, like FHA is typically 30 years, you can ask a portfolio lender to give you a lot of commercial mortgages, by the way, are 15 years already. They're 15 years with 5-year repricings. But did you know that you can get a 20-year mortgage? So let me just talk about that for a second. Years ago, I was taking CCIN classes, and one of the ones we took had to do with this very subject, your finance, calculations, things like that. And we were dealing with things like future value of current cash flows. In other words, the rents you're receiving now, what is the future value of those rents if you calculate it out 5 years, 10 years? And what's the future value of borrowed money you're borrowing now at 5%? What's the value of that money 10 years from now? And also the current value of future cash flows. So in those calculations, guess what we figured out? Historically speaking, a 20-year term is the optimum term for borrowed money. Go figure. And don't ask me to please do the calculation for you because I couldn't. This has been a lot of years, guys. This calculation, I mean, it was advanced, definitely college level mathematics. I mean, from what I remember, and we learned the formula. But fortunately, once we learned the formula, we were able to buy a calculator that did the calculation for us. But what I'm getting at is, if you measure a 30-year mortgage with a 20-year mortgage and a 15-year mortgage, and you prevailing interest rates and plot that out, it turns out the highest and best use of the money, the greatest value of the borrowed money, happens to be from a 20-year term. Just take it for what it is. So in any case, what I'm getting at is, you can ask the bank to shorten or lengthen the term on the loan. That will also have an impact on the bank's risk calculation. In other words, the shorter the term, the less risk to the bank. In other words, the longer you're stretched out, the greater risk to the bank that something could happen to you. However, the longer the term to a bank typically means the more money they make on the original principal. So it's like this crazy balancing act. They're constantly looking at all these factors: current rates, length of term, and what their history has been with defaults at each of the different intervals: 15 years, 20 years, 30 years, for example. So in any case, back to Louis' initial question. A couple things you can do is negotiate the rate. It'll go higher so that you can lock into the current rate for a longer period. You can put more money down to reduce risk to the bank, and they'll give you a more preferable rate. So in other words, you can ask for a fixed rate for 15 years, but instead of them raising the rate so much to compensate for that, offset some of that risk to them by putting more money down, and they won't raise your rate as much. Does that make sense, guys? So actually, somebody give me a quick chat here and let me know if what I just said there makes sense to you. In other words, strategy. Negotiate for a higher rate to give you a longer fixed rate on your loan. And if the new interest rate is more than you want to bear, put more money down to encourage the bank to lower that rate. Okay, so that's a kind of a combination of strategies. And also, you can shorten and lengthen the term of the loan. So let me just do a quick check on the chat box here. Let's see. Carrie Burrows says bingo. Awesome. Thanks, Carrie. So Rocky's got it. Let's see here. Louis, okay, apologize for the typos. Negative yields on bonds would seem to be a completely illogical monetary strategy, given that the U.S. has about 27 trillion in debt and debt assets. And if your interest rates were to increase by even a few points, all those bonds would be scrap paper, losing Yeah, I don't. The funny thing is, Louis, I never dealt with in the bond market much. When I owned bonds through bond funds at different periods. When I first got into investing, guys, and banking, check this out. We still had CDs paying 15%, certificates of deposit paying 15%. Um, Imagine those days. So what people were doing, by the way, let me just talk about this for a second. This is an awesome strategy for everybody here. If interest rates ever do really go up that high, let's say they even just go up to like 10% or something. As soon as you see the bond market starting to teeter, right, and it starts to level off, or worse yet, start to go down again, lock into some of those high interest rate bonds at that point, because as the bond market slides, your bond paying 10% 5 years from now could be worth a lot of money if 5 years from now their bonds are paying 5%. And you can sell those bonds for a premium. I mean, literally, people would pay you twice the bond value to get that, lock into that 10% interest rate. Well, here's how we use this as investors. And if you look at my sixth book in the chapter on creative purchasing techniques, some of you have that because I gave it to you at some of the 3-day events they were doing. If I tell you what I'll do, Beverly, when you watch it, I'm going to just leave a note for Beverly here. Beverly, if you have the chapter on creative purchasing from the sixth book, can you send it out to the participants in the email tomorrow? And I'll, guys, just look for that. It'll give you a lot of explanation here. But in any case, here's how we can use this with investors. Let's say we go through this market cycle. We're always in this cycle. And people always ask me, like, here's the most popular question right now. Hey, Gary, you think we're going to have a recession? The answer is absolutely yes. We're going to have a recession. In fact, it's already begun. I just can't tell you when it's going to actually start to drop, but the numbers are all there. Guys, it could be easily 3 to 5 years, even 6 or 7 years. The last recession didn't actually hit till the late third quarter 2007, around August, September timeframe. But there were people calling for that recession as early as the late 90s. Certainly in the early 2000s, people started calling for the recession. It was easily another 5 or 6 or 7 years. So the market we're in right now has some incredibly strong indicators. I mean, there's there'd have to be some pretty disastrous things to occur for this current market to be derailed. I think we got another good couple of years, solid years of growth and low interest rates and low unemployment. It's the most amazing thing in my lifetime. I mean, I'm 56 years old, and we haven't seen this kind of a market with the rates and growth in production, GDP, and low unemployment. I mean, literally since I was born. That's an incredible business market. So one risk is at least in the United States, the markets always respond to leadership. And I'm not making a political commentary. It's just, let's think about it. A lot of people don't like Trump because he's got a big mouth. And he just blabbers things off, and I get it. But the fact is, the market respects him, and it shows in the market indicators. I'm not condoning Trump's behavior. I'm not saying anything else. I'm just saying that, it's a historical fact. The market responds to leadership or the lack thereof, okay? So the point is whether you believe Trump's a good leader or not, the market does, okay? It's self-evident. So what I'm getting at is that could change next year with the election. If there's another, if the switches from conservative to liberal, Republican to Democrat, unfortunately, the market is going to respond. You'll know how the market views leadership, and they're going to think if they're going to be raising interest rates and raising taxes and all this stuff, taking money out of circulation, real money, not the artificial fake money, but real money, we're going to pay a price for it. Okay, but in any case, back to this: the market responds to leadership. I believe right now we're good for a long period of time. What I also believe is this is. I would not buy bonds right now, obviously, this is kind of Louis saying the same thing, right? What I would do is, if this is my personal opinion, I would borrow as much as you can borrow right now at these low interest rates, okay? I know that sounds like, well, Gary Wilson, that doesn't sound like you. Gary, you've already taught us you're conservative. I am conservative, okay? I'm also 56 years old. I've been in business for 34 years. And it's a personal choice for me to be on a cash basis, okay? Now, having said that, one of Louis' other questions was this: in the last recession, did I anticipate it, and what did I do to prepare for it? So the answer is yes. And I partly prepared well and partly didn't prepare well. Okay. The part I prepared well on was I got on a cash basis. I wasn't completely on cash. But what I had done is I'd built up a good solid equity position in my portfolio, which means I also had good cash flow. And the aim was to get on a cash basis by the time the recession hit, because then I could go out and go shopping and gobble up all these properties for cash. Well, life has a funny way of working out differently. So what happened is, God has it. We have our plans, and God has His plans. Okay, so God's plan for me was I was going to break my back and go through a divorce. So, in any case, in hindsight, it looks great because I had a lot of properties, I had a lot of equity, I had a lot of cash flow. So as the recession hit, and in a couple years into it, I find out I'm going to be going through a divorce. And on top of that, I broke my back. I'm thinking I'm in real trouble now. But thank the Lord, I had a lot of properties bringing in cash flow. See, even though I had some tenants who were unable to pay rent or they were paying late, it wasn't enough to knock me off the horse. It was, I didn't like it. I mean, there were some months I should have made more money, but I always made money. And I was able to keep everything going. I had my two oldest kids were going to college. I mean, it was crazy, guys. So what I'm getting at is I planned for being on a cash basis. I didn't get to implement my plan the way I wanted to. I didn't carry out the dream of buying tens of millions of dollars in a discount price real estate. But what it did allow me to do was go through the storm, so to speak, recession, injury, and breakup of a marriage, all that kind of stuff, in case of college, and come out okay. I was okay on the back end. I ended up eventually getting on a cash basis, by the way, years later. But what I'm getting at is I prepared for that, Louis. As soon as I started reading Barron's magazine way back in the 90s, and the editor, I can't remember his first name. He was actually his name was Barron, but in any case, he was predicting this. He kept telling us, guys, this is disaster looming, and you better be prepared for it. So I started taking his advice. I mean, I was going to my corporate library every day at lunchtime reading. I would literally go up there and take my lunch and study. This corporate library means the bank I worked for had its own library. Okay, I started doing this back in the 80s, actually. So as I'm reading all this and studying everything, all these publications, all these periodicals on interest rates on the market, I realized the facts are there, the data is all there, and guys, you can all do the same thing. And I would tell you this: turn off the TV. It's not telling you the whole truth. Sometimes they're not even telling you the truth at all. This is whether you're U.S. or Canada. Please turn off the TV. Do yourself a big favor. Go to your library and study the publications. I promise you'll get a lot more insight on the market and interest rates and finances. So in any case, years before I started plotting out how I'm going to start putting more money down, get better rates and terms, lower my debt, get on a cash basis. I didn't know when the recession was going to end. I had no idea. They were calling for it easily early 2000s, but it didn't happen. It didn't happen until again, third quarter 2007. But the point is, I was on a pretty solid footing because of all the equity I had and all the money coming in from other rentals. So in any case, let me just check my notes here real quick. To prepare, if you believe we're at or near the peak of a market, okay, and you want to prepare for the next downturn and be prepared to buy lots of properties at a discount, my suggestion is you start working on paying down your debt now, okay? Start doing it now. Also, pay down or pay off your debt. Now, what's interesting is I just told you a while ago, I would borrow right now. Well, it depends on where you are in your business. If you're just starting out, if you're just getting started, I suggest borrow and use some of the strategies I gave you in the first part of tonight's session to get better rates and terms. Get longer terms on your current rate, whether it's for 10 years or 15 years. Just do whatever you can do to get a longer rate on your loan. Okay, lock that in any way you can. If you've been in the business a long time like me, and you've already got properties, okay, and you want to use cash in this next recession, start paying those things down. Start paying them down. And then when a recession hits, and by the way, um, start paying them down and also establish yourself a business line of credit. Okay. Um, I've been talking about this a lot lately, by the way. So, business line of credit is a line of credit that's based on whatever business you have, or if it's real estate investment properties, it's going to be basically a commercial line of credit leveraging your existing portfolio. Okay. Now, used to have a lot of lenders tell me they don't want to do that. They want me to refinance everything and start over from scratch, and I didn't want to do that. Well, I finally found a lender who was willing to do the loan. And you want to write this next part down. You can always tell when we're getting close to the end of a cycle based on what the lenders are doing. Watch the lender behavior, okay? When a lender is aggressively wanting to make loans, number one, they'll tell you that in their advertisements, and their ads are going to say, come in and get a line of credit, home equity line of credit, and we'll waive the application fee, we'll waive the appraisal fee, whatever. Now, if a bank is advertising, come and open up a new checking account, and we'll give you a free toaster, that bank is not in the business of making loans right now. They need to raise deposits because maybe they get out of balance. But back to the banks who are making loans, all right? When they start doing crazy things, like giving people 100% loan, letting them borrow up to 100% of the value of the properties, that's risky business. And if you remember from the last recession, banks were not only letting you borrow up to 100% equity in your property, some of them were doing 125% equity loans. Literally, you're borrowing against the perceived future increase of your property. So when you see banks starting doing those kind of things, they're getting more creative, they're being more innovative, they're being more relaxed and more flexible and more lenient, lowering their lowering their lending requirements, like lowering what your FICO score needs to be able to borrow, then you know it's time to start preparing for the recession because it's going to happen, okay? Right now, we're seeing a little bit of that, but we're not seeing a lot of it. So the point is this. When you start seeing those indicators, crazy loan offerings, lowering borrowing requirements, you know that the recession is going to be starting sometime after that. Could be a year, it could be 5 years, we don't know. But at that point, if you're already in the game, you've already got a portfolio, you might want to start paying down to get on a cash basis. And at the same time, go ahead and lock in your commercial line of credit. That's the main thing I was getting here at this last part of the discussion is when lenders start getting very lenient, okay, and when the market's screaming along, that's the best time to open up a line of credit against your portfolio. Now, if you've already got your portfolio structured where it's owned by a company, like in Canada, we just use corporations. In the United States, we recommend to use LLCs, just straight flat LLCs. LLCs are a business. The underlying business is obviously real estate. But set up a line of credit against your LLC so it's already established. And that way, when the recession hits, you've already got an available line of credit based on the equity in your properties. That's one of the main strategies of how you prepare for an oncoming market shift. Okay, so let me just check my notes here because I wrote all this down before class when I was preparing for Louis' email. Let's see here. Did I see 2008 coming? I think we talked about that. What did I do? I started paying things down, build up my equity, build up my cash flow. Okay, another big thing here. Actually, sorry. Let me check the chat box. Okay, so this is from Louis. Investors wanting long-term security will sell their property assets and buy bonds. Is that true? Why sell property if long-term purchase? I haven't done that myself, Louis. I am extremely conservative. I'm a very conservative person. As I aged, I just really don't like debt anymore. I appreciate debt, and I encourage people to use it responsibly for buying a portfolio or building your business. Okay, if you're first starting out, guys, again, I encourage you to use debt responsibly to start building your portfolio. But as you age, you might realize it can be stressful. I mean, my gosh, I got all this debt. So if you're like me, I want to be on a cash basis now because of where I am in my life. Okay. Now that's just me. Some people I will be in debt to the day they die. And that's okay if that's what they want. What I'm saying is, depending on where you are in your life, if you're in your 20s and 30s, you can take more risk, okay? And because interest rates are low and you want to build a portfolio, no better time to do it than now, okay? Now, back to this. Another strategy you can use, guys, is this. I believe every portfolio, while you're growing it, while you're aggressively growing a portfolio, should have a mixture of multi-unit properties, duplexes, triplexes, fourplexes, on up the ladder, as big as you want to go, 10 units, 50 units, 100 units. But also what I used to do is I would always have maybe 20 or so single family homes in a portfolio, 20 to 24 single family homes. And the reason is, Louis was making the comment that real estate is not really all that liquid. And I would agree. At the spur of the moment, if you find yourself where you need to get money quickly, getting a loan is not like it's going to take a day. It's going to take probably 30 days to get a loan against your property. That's why what I mentioned a moment ago, which is, set up a line of credit ahead of time. Do that when you're comfortable. Do that when you're in good shape. Do it when the market's up. Do it when interest rates are low. Do it when the banks are being free with their money, more free-spirited with their money. The other strategy is this. If you have some single-family homes in your portfolio, okay, and you want to raise capital, you can sell a single-family home way more easily than you can sell a 4-unit building, right? More people can and will buy a single-family home, and fewer people can and will buy a 4-unit building. So the single-family homes, I would almost kind of keep sort of in reserve. I would rent them out, and I'd fix them up and rent them out. Sometimes I do lease options on them. I'd sell them. I would sell the option to buy the property at a future date and allow them basically custody of the property, or basically let them lease the property for me through a normal lease, okay? So you're granting them possession in a lease, and you're also selling them the option to buy that property at a future date. It's called a lease option. And what that does is allow me to, when I sell the option, that option fee is non-refundable. It's my money, I get to keep it. And what I'm doing is I'm giving that person the right to buy the property at a future date when the property will be more valuable. So in other words, I'm locking into the current price, today's price, and giving them the option to buy it at that today's price, but 1 or 2 or 3 years later. So the benefit to them is when they eventually do buy it, they already have equity in the property because the property went up in value. I'm also going to be their number one creditor because they're paying me rent every month. So I'm going to keep track of the rents. And when they go to get a loan, I can vouch and say, yeah, they paid their rent faithfully every single month for the last 1 year, 2 years, 3 years, whatever the case is. What the point is this is, I can do a lot of creative things with a single family home that I really can't do with a multi-unit building, okay? And of course I can sell it. I can sell a single family home. Just flat out sell it. Just sell it on the open market. So let's say I've got those 22 homes that was the average. I always had an average of about 22 single family homes. And I want to raise some capital. If somebody leases coming due, what I'll do is I'll let them move out. I'll remodel the house again to be for sale standards, not for rent standards, but for sale standards, and then price it just right below the market, just a teeny tiny bit below the market to attract buyers to buy that property fast. Then I got my money, okay? And by the way, once I have the property under contract, if I really need money fast, even though the house isn't going to sell for 30 days, you can do this next thing, which is, you're going to write this down, by the way. It's called a bridge loan. So let's say you have a property under contract to sell. It's going to close in 30 days, and you need cash now. Based on the equity in your property, like what you owe versus what you're going to sell it for, you can get what's called a bridge loan. A bank will lend you money based on that spread, and then when you sell your property, the first mortgage gets paid off, and this bridge loan gets paid off too. But you didn't have to wait 30 days for the money. You got your money right up front. Yeah, it's going to cost you a few $1,000s, but maybe you use that money to put a down payment on another bigger property. So in any case, I just gave you a big mouthful there. Let me just take a breath, get some water, let you guys let that sink in. And if you have questions, if that totally just blew you away, or you really have no clue what I'm talking about, just let me know. Or if you like the idea, if you grasp the concept You just need more details, just let me know that, because otherwise I've got another section to cover here. Thanks, Louis, for the response. I appreciate that. Louis just saying great insight. These are things I learned over the years, and some of them, when I was in banking, I got to see what happens behind the scenes, so I understood why banks did the things they did, and some things that are baffling us as consumers. It's like, well, now I can understand why the bank were doing these things. Let's see, this is from Beth. We can't do a lease option in Texas. Any other ideas? So if you can't do a lease option, Beth, can you do a rent to own? Rent to own is different. Lease option is the not $1 of rent goes toward the purchase of the property. That's lease option. Whereas a rent to own, you're taking a portion of the rent that their tenant's giving you and applying it towards the eventual purchase of the property. You're still going to be their number one creditor because they eventually do have to get a loan, right? And the bank's going to say, have they paid the rent on time? Well, of course, you're going to say yes, assuming they did. But the difference here is they start building equity right away. In other words, let's say you contribute $200 per month towards a down payment, and they're in there for 2 years. That's $4,800 that can be applied towards a down payment. And if they go and get an FHA mortgage where they only got to have 3% or 5%, that may be enough for them to qualify as their down payment, and then they get the loan for the other 97 or 95%. But there's risk in that. Here's the risk, guys. When you do a rent to own, as soon as you give a person $1 in equity stake in your property and they default under lease on the lease for the property, you can't evict them. You got to foreclose on them. Okay, you got to go in and foreclose on them. Even if they have $1 in equity. In fact, if you go to file for eviction because they did not pay the rent on time, and they go in there with that rent-to-own agreement, and the judge looks at it and says, well, that's a rent-to-own contract. The tenant already has so many dollars in equity. I can't hear the case. They won't hear the case at the magistrate's level. They have to go to what's called the court of common pleas level, which is typically the county level, or if you're in Louisiana, it's the parish level. And it is a long, drawn-out process. In Texas, it's easy. It's easier to evict people in Texas. But in like California, New York, or up in Canada, Quebec, and Montreal, Toronto, it's not an easy thing to evict somebody. In fact, you can evict people in the wintertime. They won't let you. You can get judgment. You can get possession granted, but you're not going to get your property back. And people will take it because you can't kick them out on the street. You can't do that up in Toronto. In any case, so Beth, I would check in on that. And here's something else you can do, guys. I'm going to give you a really unique strategy, and I got this from a fellow Texan. He's actually my uncle. He lives up in Magnolia, which is kind of northwesterly of Houston. And what he does is they'll buy properties, steep discount, foreclosed properties in distress, for people who are going to lose their property. They'll step in and do a workout and take over the property. What they'll do is they'll fix it up, make it more valuable, but instead of selling it outright, what they do is they become the lender, okay? And they're going to finance the purchaser of the property. And the typical purchaser is somebody who can't get a traditional mortgage right now. So Uncle Don will not just charge 3 or 4 or 5%. He's going to charge, 6, 8, 10%, depending on the person's creditworthiness. So what he's getting is, he's getting money that's coming in like a rent payment, but he has no maintenance. The tenant essentially takes title to the property. They've got to take care of it. The buyer has to replace anything that goes wrong, furnaces, anything like that. Make all maintenance repairs. So my Uncle Don, has a true net return. What he gets in those mortgage payments is his to keep. Okay. Now I know you might be wondering, well, how the heck did he do this? Well, he's in his 70s, and he just his whole life he did like I did, just invested, and he became the lender. I do different things with what I don't like finance people directly. I'm going to say that this serves for different class. But back to him. So in Texas has very favorable owner laws. Okay, so if someone gets foreclosed on in Texas, the whoever is being foreclosed on, the borrower, might as well just walk away. They got that's it's not like California, New York, when it can take you literally 13, 14, 15, 16 months to foreclose on somebody in those two states. Texas is very owner friendly. Florida is, Georgia is, a lot of the southern states are, okay? So what I'm getting at is, what he can do with those notes, let's say he wanted to raise money, he has a note and a mortgage, right? That note can be sold for profit. He can take that mortgage, that note that's attached to the mortgage, sell it on the open market because he's making 10%. And most people are making a fraction of that right now, right? They're getting, most lenders are getting 3, 4, or 5%. He's getting 10%. That mortgage is worth a lot more money face value than a mortgage is receiving 3 or 4 or 5%. So if you're in that kind of position, and a couple of you are, because I know you personally, you may want to consider that strategy. And if you're not residing in Texas, work with someone like Beth, okay, who can help you find these properties, and then you can be the lender, right? So in any case, that's another great option. If you don't want to do like a lease option, you can basically sell it and be the lender, okay? In any case, I want to make sure I'm covering all my notes here. Hang on one second. I talked about using single family homes. The easiest way is just to sell them. If you want to cash out and use that money for buying a bigger property, just sell a single family home. It's easy to sell. You can set up a line of credit in advance. In other words, the time to get approved for a loan is when you're looking good, the economy is good, everybody's happy, and the lender's starting to kind of loosen things up a little bit. That's when you want to establish your lines of credit. The reason I like lines of credit are because you can borrow from the line of credit and pay it back, and borrow and pay it back. It's very lenient and flexible, as opposed to a fixed rate term loan where you get the money all up front and you got to deploy it, and then you got a fixed payment for all that time. I prefer lines of credit because I can borrow and I can pay it back, borrow and pay it back. And one of the things I used to do was I'd borrow against it to buy the next property, fix up the property, raise the rents, raise the value, and then finally get a brand new first mortgage on that, and then pay back the line of credit. So the line of credit keeps being reused, recycled over and over and over again. And by the way, as you add more income producing assets to your portfolio, typically the commercial lender will keep giving you, increase your limit, okay? That's one of my all-time favorite strategies. So I tell you what, I think we should probably start to wrap this up. I did talk about the recession, and the reason why Canada didn't have the big recession is because, we don't sell mortgages in Canada. There's no secondary market, okay? So the lenders in Canada are much more disciplined. They do much stricter due diligence on their lending practices. They have very few foreclosures up there. Something else too, I just want you to take this to heart. The last recession, guys, was very unique in that it was definitely real estate driven. It was driven by improper lending practices related to real estate, okay? So it was a real estate driven recession. Most recessions are not driven by real estate. Real estate is a factor, but it's just one of many factors. Some recessions are just simply cooling off periods. So the economy gets too hot, interest rates start to rise, inflation is rising, and it just cools off. And it involves basically, the financing market, the bond market, and so forth. It's not really directly related to real estate, for example. Real estate is just one of the factors. Okay, so last recession was very unique. Now, I'm not saying it can't happen again. I just hope that we learned a lesson and we won't let that happen again. I do believe we're going to have another recession. I just don't know when. I think it's going to be easily, could be 3, 4, 5, 6 years down the road, unless something really dramatic happens, a meteor hits the planet or something like that. I don't think we're hitting any wars. I know people were afraid of that, but let's face it, there's not going to be a war. It's not going to happen. I'm not trying to be political here, but right now, China is actually coming around and starting to negotiate on tariffs. That what we tried is working, okay? Same thing with other countries. Between U.S. and Canada, there was a lot of debate going back and forth about the dairy business and beef, okay? But the fact is Canada is doing really well right now. In fact, because of the U.S. and what we're doing with China, Canada is benefiting. So in any case, with all those factors involved in my understanding of business, um, I tend to be a little bit on the optimistic side, but I studied these markets for years, and I know that we're in what's called peak status, but it looks like it could keep going. And I wish I could tell you I knew when, but I don't. What I know is it definitely is going to happen. So what I want you to do is prepare for that by taking action now. So again, strategy, if you're just starting out, I would say borrow as much as you can. Um, Strategy, if you're later on in life and you want to be more conservative, to start paying down some debt and open up a line of credit. Either way, open up a line of credit so you can take advantage of the market when it does shift, okay? Um, in any case, that's my story and I'm sticking to it. Let me check the chat box here. My gosh, we're actually all caught up on questions. Hey guys, I'm going to go ahead and wrap this up. I hope you like this subject. Sometimes I'm a contrarian, sometimes I'm controversial. I just don't like playing the bank's game, quite frankly. I want to be in control, so I want you to do the same thing. In the beginning, you're going to have to borrow from banks, okay? And I get that. But I want you to do is have a long-term plan to, when you borrow, not have to borrow out of need to buy a property, be able to buy a property using equity in your existing portfolio, and then later on refinance, put a new mortgage on that, replenish your line of credit, and go out and keep doing that. That puts you in control. Yes, you're borrowing, but you're borrowing against yourself, which puts you in control. I know some people will say, Gary, well, that's risky. I tell you, it's actually a lot less risky than completely stringing yourself out there, okay? But in any case, David, thank you for the comment there. Appreciate that. Guys, I hope you have a wonderful evening. Remember, next week we moved it to Monday night from Tuesday night. Louis, you're very welcome. Thank you for the comment. I appreciate that. In the meantime, guys, God bless you and your families. Whatever you celebrate during the holiday season, I know a lot of Americans, we got Thanksgiving coming up. I'm lucky because I get to celebrate two Thanksgivings, Canadian Thanksgiving October and U.S. Thanksgiving November. And I celebrate two Christmases, obviously, at Christmas time. If you celebrate Hanukkah, happy Hanukkah. If you celebrate Kwanzaa, happy Hanukkah, happy Kwanzaa. Whatever you celebrate, God bless you and your families. And I hope you enjoy every moment of this precious, precious season. And please set up strategy calls. If some of you are doing really good with that. If you're stuck on something, that's the time you set up a strategy call. So you guys have an awesome night, and I will see you next week. Okay, take care, and God bless. I'm going to, oops, sorry, stop recording.